Welcome back to this special deep dive episode of the Daily Crypto Roundup, where we take one story, one moment, one shift in the landscape, and break it down properly. No quick summaries, no surface-level recaps. We go into the details, the psychology, the data, the market structure, and we talk about what really happened. And today, we're diving into something that every trader, investor, and long-term holder has been talking about. Bitcoin's worst month since 2022. A month where everything that could go wrong did go wrong. A month that exposed cracks in the system, revealed hidden leverage, and showed us how Bitcoin behaves now that it lives inside an ETF-driven world dominated by institutions, macro flows, and global risk sentiment. This month wasn't just a dip, it was a diagnostic test, one that told us a lot about where Bitcoin really stands in 2025. Before we get started, just a quick Christmas thank you. We're giving away 50 XRP to 2 listeners before Christmas. All you need to do is rate the podcast 5 stars and comment "done" below this episode so we know you're in. And if you've already rated the show, just comment "done" and you're included. Good luck, and let's get into it. All right, let's get into why Bitcoin just had its worst month since 2022. And I want to start not at the chart, not with the candles, not with the liquidations, but with the psychology. Because every major Bitcoin crash has a mood. The 2018 crash had fear mixed with disbelief. The COVID crash had pure panic. The 2022 crash had exhaustion, capitulation, and a sense that everything had fallen apart. But this one? This month? The defining emotion was confusion. Confusion about why the selling started. Confusion about why buyers didn't step in. Confusion about why ETFs didn't catch the fall. And confusion about why a market filled with so many strong fundamentals, halving completed, inflows rising, institutional ownership increasing, suddenly fell through the floor. To understand this month, you need to understand that Bitcoin is no longer a retail-driven asset. It is no longer volatile because of whales or exchanges or niche news cycles. Bitcoin is now a macro asset. Its price moves with interest rates, treasury yields, liquidity flows, and risk sentiment. And the moment global markets flipped into risk-off mode, the moment tech stocks rolled over, the moment AI plays pulled back, the moment bond yields surged, Bitcoin didn't behave like a hedge. It behaved exactly like a high-beta technology stock. In fact, according to Reuters, which reported this shift in detail, one analyst described Bitcoin's behavior as almost identical to a leveraged tech stock. And that really is the perfect description of what happened. The selling began quietly, not with a plunge, but with hesitation, slow red candles, weak rebounds, and decreasing volume. It didn't look like fear. It looked like uncertainty. But behind the scenes, something more dangerous was building. The ETF inflow slowdown. For months, Bitcoin ETFs had been absorbing every dip. Whenever Bitcoin fell, ETF buyers stepped in and caught it. But last month, the inflows dried up. Not just slowed, they almost stopped. And that removal of a key demand pillar created a structural problem. Without ETF inflows, the market became thin. And in thin markets, every sell order matters more. Every panic move cuts deeper, and every liquidation hits harder. And liquidations were the next big domino to fall. According to Decrypt, more than $2.2 billion in long positions were wiped out within 24 hours during the heaviest part of the crash. These weren't retail gamblers on 100x leverage. These were medium leverage swing traders, professionals, algorithmic systems, and even structured products tied to price levels. When liquidation algorithms activate, they don't care about fundamentals. They don't care about support levels. They don't negotiate. They just dump into the order book at whatever price is available. And because the ETF inflow safety net wasn't there, those liquidations cascaded. One triggered the next, which triggered the next, and suddenly Bitcoin wasn't just dipping, it was unwinding. But the most underreported part of this entire month came from a story in Business Insider. Bitcoin was on track for its worst monthly performance since 2022 because of forced selling, not fear, and because of margin stress in institutional portfolios. This is the new Bitcoin, the kind that lives inside hedge fund dashboards, asset manager portfolios, automated rebalancing systems, and risk-adjusted models. These systems aren't emotional. They don't panic. They don't FOMO. They simply follow instructions. And when volatility spikes and asset correlations shift, those systems sell Bitcoin the same way they sell tech stocks, growth names, and high-risk equities. And this leads us to one of the most important elements of the month: corporate crypto treasury destruction. According to The Block, publicly traded companies with crypto on their balance sheets lost more than $70 billion in combined market cap in a matter of weeks. And that number is devastating. When publicly traded firms fall that sharply, it sends a signal to Wall Street that crypto exposure is too volatile, too unpredictable, too risky, and that fear filters straight back into Bitcoin. Now, at this point in the deep dive, we're going to take a quick break and thank today's sponsors. Don't go anywhere.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
All right, let's get back into it. During this month, we saw something interesting, not just in price, but in behavior. Bitcoin's drop wasn't accompanied by a collapse in on-chain metrics. We didn't see miners panic. We didn't see exchange reserves spike. We didn't see wallets dumping long-term holdings. In fact, long-term holder behavior remained stable. That tells you something crucial. This wasn't a collapse of belief. This was a collapse of structure. It wasn't about fundamentals. It was about liquidity. The best way to understand this is to look at the derivatives market. Funding rates flipped sharply negative as open interest collapsed. Traders who had been building structured long positions for months suddenly found themselves underwater and were forced to unwind. But interestingly, the unwinding wasn't violent. It was mechanical. Slowly, over days, the leverage drained out of the system, and the more the market fell, the more the leverage drained, until eventually the drop wasn't driven by new sellers. It was driven by the absence of buyers. And this is where the story becomes fascinating, because amidst all of this panic and instability, something strange happened. XRP massively outperformed the market on a yearly basis. According to 24/7 Wall Street, XRP was up 89% year over year, compared to Bitcoin's 3.6%. In a month filled with collapses, liquidations, and uncertainty, XRP became one of the strongest assets on the board. And that tells you something about market segmentation. Not every coin is being treated the same way anymore. Bitcoin behaves like a macro asset. XRP behaves like a regional liquidity instrument. Solana behaves like a high beta growth stock. The market is fracturing into distinct categories, something we've never seen before. Another detail that hasn't received enough attention is the behavior of long-only institutional portfolios during this entire month. Normally, when volatility spikes, you see major funds aggressively de-risking across every asset class. But this time, a lot of large players didn't actually sell. They simply stopped buying. And that is a completely different kind of pressure. When institutions freeze rather than exit, the market doesn't collapse because of mass selling. It collapses because the buy side disappears. This is why every dip felt heavier than the last, even though outflows weren't as dramatic as previous crashes. The absence of buyers becomes its own form of downward momentum, and it creates these long stretches of weakness that feel like panic, even when no one is deliberately panicking. Another interesting detail came from Binance CEO Richard Teng, who publicly stated that Bitcoin's volatility this month was in line with other major asset classes. And while people mocked that statement online, he wasn't wrong. Tech stocks fell, AI equities fell, Growth portfolios fell. Even treasury-heavy funds struggled. Bitcoin didn't behave like an outlier. It behaved like part of the global risk complex. Whether that's a sign of maturity or a sign of dependence is a debate for another episode. But the behavioral pattern is clear. Bitcoin isn't the outsider anymore. It's in the room with the big boys now. So how does this month actually end? What does it mean? And what comes next? Well, here's the part that almost nobody is talking about. The worst of the selling pressure appears to have slowed. The final phase of the month didn't bring panic. It brought exhaustion. When buyers start slowly returning at key levels, not aggressively, but patiently, it often signals the market is reaching emotional equilibrium. Not a bottom, not a reversal. Just the moment where fear stops creating new sellers. And that matters, because every single Bitcoin recovery in history starts with fear exhaustion. Not greed, not optimism, not good news, just exhaustion. Just the moment the market becomes too tired to panic. And right now, despite everything we've seen, the ETF inflow freeze, the liquidations, the corporate treasury collapse, the macro rotation, the market isn't collapsing anymore. It's hesitating. And hesitation is always the first phase of stabilisation. And the final question everyone is asking right now is the obvious one. How does Bitcoin recover from this and push back toward that long-promised $100,000 mark? The answer, surprisingly, is far less about hype and far more about mechanics. According to Tom Lee from Fundstrat, one of the most consistently bullish analysts on Wall Street, and someone with a long track record of calling major Bitcoin cycle moves, the road back to $100,000 doesn't require perfect conditions. It simply requires the three things Bitcoin has historically thrived on: stabilizing inflation, a return of ETF inflows, and a reduction in forced liquidations. Lee said recently that once ETF inflows resume their upward trend and market volatility normalizes, Bitcoin's supply shock dynamics kick in again, because there just isn't enough available Bitcoin to satisfy institutional demand. In his words, when the excess leverage clears, Bitcoin doesn't recover slowly, it snaps back violently. Whether you agree with him or not, the logic is hard to ignore. The structure that dragged Bitcoin down this month is the same structure that will eventually send it higher. And that is how the road to six figures becomes a matter of timing, not fantasy. We'll leave it there for today. Make sure you follow the show, rate it 5 stars, join the Christmas giveaway by commenting "Done," and as always, we will see you at the top.